99 years. That's the length of the lease some cities have signed away on their own highways, handing control of a road built with taxpayer money to a private investment group for nearly a full century in exchange for a check that gets cashed once and spent within a handful of years. If that sounds like an odd trade, it is, but it's also one of the most quietly lucrative financial instruments in American infrastructure, and almost nobody driving across one of these roads has any idea it's happening under their tires. Here's the reframe worth sitting with before we go further. A toll road isn't primarily a way to pay for asphalt, concrete, and snowplows. In most of the big-dollar toll deals in this country, the physical road is almost incidental. What's actually being bought and sold is a multi-decade claim on a predictable stream of cash from drivers who have no real alternative route. And once you see the toll booth as a financial instrument instead of a maintenance fee, the pricing, the fine print, and the fees all start making a very different kind of sense. Let's start with the deal that basically wrote the modern playbook. In 2005, the city of Chicago leased the Chicago Skyway to a private consortium for $1.83 billion for a term of 99 years. The city took that money and used a chunk of it to pay down debt and fund reserves, spent, in effect, within a few budget cycles. The private operator, meanwhile, got the right to collect and raise tolls on that road for essentially the rest of this century, long after everyone who negotiated the deal has retired. That's not maintenance funding. That's a nearly century-long revenue lease, priced like a bond, sold once for cash up front. And here's where the story gets more interesting, because the state of Indiana ran a similar play the very next year, and it shows you what happens when the traffic projections don't hold up. In 2006, Indiana leased its toll road for $3.8 billion over 75 years. The operating company took on heavy debt to finance that lease, banking on steady toll revenue to cover the payments. Then the financial crisis hit. Traffic came in lower than projected, and by 2014, the operating company filed for bankruptcy. The lease itself didn't disappear. It got resold in 2015 for $5.725 billion to a new set of investors. The road never stopped operating. The tolls never stopped collecting. What changed was simply who owned the right to that cash flow, which tells you plainly what these deals actually are. Financial assets with a highway attached, not highways with a financing plan attached. So if the real product is the cash flow, the next question is obvious. How do you make that cash flow grow every single year without drivers revolting? This is where toll escalator clauses come in, and they're baked directly into the concession contracts, usually in language nobody outside a law firm ever reads. A common structure sets the toll increase at whichever is higher, a fixed rate like 2%, the rate of inflation, or the growth rate of the regional economy. Whichever number comes out biggest, that's what gets applied, every year compounding. A toll that starts at $2 can, over a couple of decades of compounding increases, end up well north of $4 or $5, without a single public vote, without a ballot measure, without anyone having to justify the specific increase in that specific year, because the formula already justified it the day the contract was signed. Now here's a piece of these agreements that rarely makes it into local news coverage, and it's arguably the most important clause in the whole document: non-compete provisions. Some concession agreements include language that restricts the government from building or substantially improving nearby free routes that would divert traffic away from the toll road, sometimes for decades at a stretch. Think about what that actually means. The public sector isn't just selling the right to collect tolls. In some cases, it's agreeing to protect the toll road's customer base by limiting its own ability to improve competing infrastructure nearby. That's not an accident of drafting. That's the private operator protecting the traffic projections that its entire debt structure was built on, because if a free alternate route gets widened next door, ridership drops, revenue drops, and the bonds backing the whole deal get shakier. Let's talk about how you personally get charged more without ever seeing a price increase on a sign. Most toll authorities now run two separate charging systems side by side: the transponder rate for people with a prepaid account and a little plastic tag on their windshield, and the video toll or pay-by-plate rate for everyone else. The video rate is almost always higher, sometimes $1 or $2 more per crossing, sometimes significantly more once administrative processing fees get added. A toll that's $1.60 for transponder users can show up as $3 or more on a mailed invoice for a driver who is just passing through without an account. Multiply that gap across the millions of out-of-state and one-time drivers who cross these roads every year, and you're looking at a meaningful secondary revenue stream that exists purely because of how the payment method is structured, not because the road cost more to build for those drivers. And then there's the fee structure that generates outsized returns relative to the actual toll owed. Violations. Miss a toll payment. Maybe your transponder didn't register. Maybe you didn't know a road even had a toll. And what started as a charge of $1.50 or $2 can turn into a violation notice with fees stacked on top, sometimes reaching $50 or $100 per unpaid crossing once administrative penalties are added. If you don't pay that either, some jurisdictions escalate again, adding late fees or referring the account to collections. A handful of missed tolls across a commute can, in theory, snowball into several $100s of fees on top of maybe $6 or $8 of actual road usage. That imbalance isn't a bug in the system. Violation and processing fees are a documented, budgeted line item in how many toll authorities and their private partners model expected revenue, precisely because a predictable percentage of drivers will always miss a payment. Now let's move to the part of this industry that's grown the fastest over the last decade: managed lanes, sometimes called express lanes or hot lanes, which stands for high occupancy toll. These are the lanes running parallel to a free highway, usually separated by a painted buffer or a barrier, where the price isn't fixed at all. It moves in real time based on how congested the free lanes are. During a normal midday hour, the toll on a stretch like this might sit around $1.50 or $2. During a bad rush hour, on a heavily used corridor, that same short stretch can price itself up to $20, $30, even over $40 for a matter of a few miles. The algorithm isn't guessing, it's calibrated to keep exactly enough cars in that lane to maintain a minimum guaranteed speed, usually around 55 miles per hour, which means the price isn't really about the cost of the pavement at all. It's a live auction for a guaranteed travel time, sold to whichever drivers value their next 20 minutes enough to pay for it. The free lanes right next to it are doing the same job for the same destination, just slower. Here's the part that changes how you read those dynamic price signs on the highway shoulder. The algorithm isn't optimizing for driver fairness. It's optimizing for two things simultaneously: keeping that lane moving fast enough to satisfy the performance guarantees written into the contract, and maximizing revenue per available lane mile during the exact hours when demand is highest. Those two goals happen to align perfectly, which is exactly why the pricing swings as hard as it does. A commuter who drives that stretch twice a day, 5 days a week, at peak pricing can end up paying more per month for a few miles of expressway than some people pay for their entire car payment. So who actually finances all of this? And where does the toll money go once it's collected? Most large toll projects, public or private, are backed by toll revenue bonds. Investors buy those bonds expecting to be repaid from future toll collections, plus interest. That means a large share of every toll you pay isn't going toward this week's pothole repair. It's going toward debt service, covering interest payments to bondholders who financed construction or financed the concession purchase price years or decades earlier. Rating agencies assign credit ratings to these bonds based largely on projected traffic and revenue, which is exactly why traffic forecasts matter so much to the financial side of this industry. Overly optimistic projections, like the ones that hurt the Indiana toll road deal, can put an entire financing structure at risk if actual driving habits don't match the model. Maintenance and operations, by comparison, tend to be a modest slice of the overall toll revenue pie on many of these corridors, often well under half, sometimes closer to a third, with the rest split between debt service, reserve funds, operator profit margins, and in the public-private deals, returns owed to the private equity or infrastructure fund that financed the concession in the first place. That's worth sitting with for a second. A driver assumes their toll dollar is primarily a road upkeep dollar. On many of these systems, it's closer to being a bond service dollar first, and a road upkeep dollar second. It's also worth being fair here, because not every toll road runs on this exact model, and painting the whole industry with one brush wouldn't be accurate. Plenty of toll roads and toll bridges are publicly owned and publicly operated from top to bottom, with no private concession involved at all, where toll revenue really does flow directly into a dedicated maintenance and construction fund with public oversight and public board meetings about rate changes. Older toll authorities, the kind that have existed since the mid-20th century turnpike era, often operate this way, with toll rates that have stayed relatively modest for decades because there's no investor return baked into the pricing formula. The financial engineering we've been walking through applies most sharply to the newer wave of long-term private concessions and to dynamically priced express lanes, not to every toll booth in the country. There's one more layer worth naming because it explains why states keep choosing this model even when the public math looks uneven over the long run. A 99-year lease payment shows up as cash in the current budget right now, solving an immediate deficit or funding an immediate project, while the cost, decades of toll increases paid by future drivers, lands on people who aren't in office to be held accountable for the decision and, in many cases, aren't even born yet when the lease is signed. That mismatch between who gets the short-term benefit and who pays the long-term cost is a structural feature of how these deals get approved in the first place, and it's part of why so many of them keep getting made, deal after deal, decade after decade, across different states with different political leadership. Put it all together and the toll booth stops looking like a simple pay-for-use fee and starts looking like what it actually is on the busiest, most heavily financed corridors in the country. A long-duration financial product priced with escalator clauses, protected by non-compete language, monetized further through payment method surcharges and violation fees, and in the case of managed lanes, dynamically auctioned in real time to whoever needs to save the most minutes on a given afternoon. The road is real, the asphalt is real, but the number flashing on the sign above your lane was, in a lot of cases, set by a financial model built years before you ever got in your car that morning. If breaking down the real financial engineering behind everyday systems like this is the kind of thing you want more of, subscribe so the next one lands in your feed, and if this changes how you read that dynamic price sign the next time you're sitting in traffic, tap like so it reaches someone else stuck in the same